Hello and welcome to the look ahead for Friday, the 1st of December, with me, Fiona Cincotta, Senior Market Analyst at City Index. And yes, you did hear that right. It is actually December already. Goodness knows how we got that. But moving on, we have no major earnings that we'll be watching out for tomorrow, but there is plenty on the economic calendar. Kicking off with the Chinese Caixin manufacturing PMI for November. That's expected to come in at 49.8, just up slightly from 49.5, but still below that key 50 level. We had the official data out today from China, and actually the manufacturing PMI came in weaker than expected. So potentially there is room for disappointment with tomorrow's data as well. And then moving on, we do have the Eurozone manufacturing PMI, which is expected to, well, this is the second reading, the final reading for November. It's expected to confirm the initial reading of 43.8. That's up marginally from the 43.1 that we saw previously in October. Now, the data comes after we've had quite a lot of data from Germany particularly, and the Eurozone. We had Eurozone inflation figures out today. Now, the Eurozone inflation cooled by more than expected to 2.4% year on year. That was down from 2.9%, which really does bring that ECB target of 2% very much into the spotlight. You know, they don't seem so far away from that target anymore, even though we have heard ECB President Christine Lagarde saying that the fight against inflation still hasn't been won. Those were her comments still earlier this week. So as far as PMI data is concerned, we are, as I said, expecting that tick higher. But the euro has actually come under pressure following this weaker than or cooler than expected inflation data. Obviously, that means that the ECB are likely to have finished with their rate hikes, and the attention is very much on when the ECB could be looking to cut interest rates, and the attention is particularly on the second quarter of next year. Now, this has put pressure on the euro. We can see the euro has been falling sharply today. It's fallen away from that 3-month high that it reached earlier in the week, but this is also on the back of some US dollar strength. We're seeing the euro US dollar, it almost reached that. Sorry, no, it did actually reach that 110 level, just breached 110, but actually now it's falling back towards the 109. We see some support there around the 108.50 level, and a break below that brings the 200 SMA back into focus. If we do see a break below that 200 SMA, I think that's when we're going to see the bears really get back control of the pair. Buyers going to look for a rise above that level of 110.20, which was the weekly high. So just having a look back at what else we'll be watching tomorrow, we've got the UK manufacturing PMI. Now that's expected to again confirm the earlier reading of 46.4. That's the preliminary reading, which is an improvement from 44.8, but still, like in the Eurozone, below that 50 level, which separates expansion from contraction. The pound has been having an interesting ride of late. We've had comments from the Bank of England earlier in the week. Bank of England Governor Andrew Bailey saying that he will do whatever it takes to get inflation in the UK back to the 2% target. Now, in this PMI data, as well as the headline figures, new order figures will also be watched, but also prices paid. And that will give us some clues over expectations for inflation, whether prices paid are easing still. The pound as well has come under pressure today. Again, that's partly to do with the stronger US dollar that we've seen. Now, the pound, it rose to a high of 127 this week. It's fallen away from that 3-month high back towards 126. It's actually around, it's finding support on that rising trend line that we can see that dates back to just at the end of September. So, I mean, if we do see a break below there, then I think around the 124.50, which is the August low, will be the next level to keep in mind. Buyers are going to be looking for a rise above 127 in order to create a higher high. Just moving on now, we also have data from Canada. So Canada unemployment is going to be in focus, expected to tick higher to 5.8%, up from 5.7%. That comes after Canadian GDP data today, which was slightly weaker than expected. And also ahead of the Bank of Canada interest rate decision next week. Now, the Bank of Canada is not expected to hike rates again. In fact, well, at the meeting even, but probably not again either. We had comments from the governor, Tiff Macklem, who basically hinted this week that the Bank of Canada had reached peak rates. So moving on, we also have, I did say it was busy tomorrow. We've got the US ISM manufacturing PMI. That's expected to come in slightly stronger than in October. That's October we've got up there where it slipped to 46.7. It's expected to come in at 47.6, again below that 50 level, separating expansion and contraction. Interestingly, the data also comes after we've had a series of data from the US. Today we had that core PCE, which has been a huge focus for this week, and it actually came in as expected, in line with forecasts, easing to 3.5% year on year. That's down from 3.7%. So, we're at this really nice Goldilocks spot as far as data in the US, where we've got inflation cooling, we've got data also showing signs that the economy is starting to cool, but nothing too concerning. There's no sort of alarm bells ringing there. So that looks like, the Federal Reserve is on track to achieve that soft landing, which will be really key to keeping sentiment supported as we head into 2024. Now, what did happen? We also had jobs data today, jobless claims. Jobless claims were mixed. They came in slightly stronger than expected. The initial jobless claims up at 218,000. That was below the 220,000 that was forecast, but continuing claims were quite a bit stronger than expected. And that suggests that Americans that are out of a job are finding it harder to find employment. So there is some signs of weakness coming into the US labor market as well. Now, as I said, talking about being in that sweet spot, that's been pretty good news for US equities, which have had a phenomenal month in November. I think we've seen it's been S&P's on track to gain around 8.5% this month, the NASDAQ 11%, Dow Jones 7.1%. And this is as we've seen bond yields fall. We've seen there's been a rush in demand for US treasuries, which have had their best performing month since the 1980s, on the back of expectations that the Federal Reserve is going to be cutting interest rates as its next move, rather than hiking rates further. That's been really supportive of equities. We can see on this chart that beautiful run up across November, but we have just run into I would say a period of consolidation. The bulls are running out of steam there. We couldn't push higher above that 45.85 high this week. And the price is just settling around that 45.50 level, which is the August high. So as far as what to expect there, I think we're going to be looking, if we're going to look for a rise above the 45.85 in order to target 46.00, which is the July high. But if we do see a break below that 45.50 level, which is pretty much held for the past couple of weeks, then that's going to bring in 44.00 into focus. That's all for me. Oh no, one more thing to remember. Federal Reserve Jerome Powell is going to be speaking. How can I forget? Possibly one of the most important points about tomorrow. That obviously, if the markets are going to be looking for comments of what to expect as far as interest rate cuts are concerned, is there going to be any hints from Federal Reserve Jerome Powell about when the US Federal Reserve will consider or start considering a dovish pivot? Don't forget, we heard from Federal Governor Christopher Waller earlier in the week, and he hinted towards that dovish pivot, which got equity bulls rather excited and sent the dollar lower. Anyway, so thank you very much for joining me. I hope you like what you've seen today. If you do, then please remember to press the like button. And if you would like to see more videos like this, then do sign. Thanks very much.